On Thursday, the market produced a bullish signal that has a 100% short-term and long-term win rate. It's the Zweig breadth thrust, which you've probably seen all over social media, and it's based on a 10-day moving average of the advanced decline line signaling a move out of oversold territory. However, the market still needs one more confirmation from the bulls on the volatility front before I would say that we're actually in the clear, and this is based on the new advent of 0DTE SPX options, of course. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame chart, talking about candle structure and location as we always do. In terms of structure last week, we've got a solid green-bodied bar with a meaningful lower wick. The reason I'd call it meaningful is because, of course, on Monday there was that fake breakdown to the downside. The sellers were unable to hold prices underneath the previous week's low, which is a great segue directly into location. On the bar-to-bar count, we do, of course, have the lower low, but notice that we also have a higher high, and the close is completely outside of and above the previous week's range. So this is technically a bullish engulfing bar, which is bullish, of course. There's just no arguing with that. If we had stronger sellers, you would have expected, again, on the breakdown here, some more acceptance underneath the prior week's range to sustain some sort of 2-bar downtrend, and it just didn't happen. So both structure and location go to the bulls in the short term here, but if we're still considering the overall trend, remember that we still have highs. We have lower highs, and it's still possible that some sort of lower high could be produced around this area. Although, as we get to the daily time frame chart, what we'll see is there's technically a break of this precise level. Remember that the trend is still down, though, right? We have lows, we had lower lows, and this, of course, is the lowest low in the trend count down here, and this would potentially classify as a lower high still, a counter trend move off of the lowest low. Now, as we've said over the past couple of videos, it is possible, and I am open-minded to this acting as a weekly higher low in confluence with a daily higher low as well. Both of those things can take place at the same location since this range here has been so wide. Is there any other confirming indications that would suggest, okay, a bottom might be starting to form on the weekly time frame? If we take a look at our Fibonacci's, remember that the breakdown on Monday was so substantial because it was underneath the Fib 38.2 from this perspective, as well as from the lower high perspective here. If I do something that looks like this, Monday got us back down underneath that Fib 38.2, underneath the previous week's range low, and as you can see, based on Friday's close, we're back over this 61.8, which would increase the odds that we do ultimately see some sort of 100% retracement. The more weekly bars we can close above the 61.8, the higher the likelihood of that taking place here. If we clean that up and take a look at our anchored VWAPs on the weekly time frame chart, keep in mind that we've still respected the 2022 low, which is down here at the 200 SMA on the weekly as well. The overshoot here of this cluster of moving averages has been resolved. You can see that last week's Monday low actually went right to the gray anchored VWAP, right, which comes from back here, the peak before the monthly higher low pullback into the end of 2023. You'll notice that we've closed right at the anchored VWAP from the all-time high, which is going to be a top watch into the coming week's worth of trade. If the market can reject the opportunity for a lower high, I know that sounds like a double negative, meaning if we can break out through this level, get some continuation in the upward direction over roughly 550, that would look really constructive on the weekly to avoid the lower high threat. If we take a look, and by the way, it's still there, right? The market, of course, could rotate back to the downside. The lower high would persist. So we really do need, on the weekly, a little bit more acceptance, a stronger close, more distance over that 550 level, over this anchored VWAP threat. As we take a look at the volume profile on the weekly time scale, I would just continue to point out that the Monday breakdown, again, this threat there, and the reason we called the emergency meeting was because it was very substantial underneath a number of meaningful reference points. The high volume node was actually broken below, and as of the Friday close, you can see that we've completely recaptured that. And even if I take this high volume node, which is the highest volume node after the low volume void, you can see that we've closed above that. So definitely some progress here in the upward direction on the weekly time scale that makes me think we should keep an open mind to the failure of the sellers to produce a lower high here, right? It wouldn't be unreasonable maybe if the market consolidates and then breaks out or gets continuation, but my first thought based on candle structure, where we are in the VWAP sequence, the Fibonacci's, the whole 9 yards, I would have a slightly more open mind to better than expected outcomes here in the upward direction over 550, not just a straight up rejection of this level at the previous low. Let's take a look at the daily time frame chart, and let's firstly evaluate this week's expected move. If you're not familiar with the expected move, it is this gray shaded area right here, and the video tutorial on the study is linked up there in the top right hand corner. If we're contained by the upper bound, the number is at 565.50, and that of course implies a higher high relative to last week's range. It's also noteworthy that this is a higher high over the weekly threat, right? This level is the lower wick of that weekly threat bar that we were just talking about. Its confluence with the top of the range from the 90-day pause rally. As we think about the lower edge of the weekly expected move, the number is at 535.88, give or take, and that of course would imply a higher low in the daily trend count, and it would also suggest that it wouldn't be unreasonable to leave this gap here from the Wednesday morning session unfilled. And an unfilled gap would remain as a bullish data point walking forward. So expected move is bullish in the trend count, and speaking of the trend count, very important, right? Let's talk about what the trend is on the daily time frame chart. The base case is almost right back in play. Remember that this is the capitulation low, and we were looking for a structural higher low right here into the early stages of this week. I want to fully acknowledge that on Monday, when we called the emergency meeting, it was looking pretty detrimental to the base case for all the reasons we've already talked about on the weekly, but clearly the threat after Monday's close down here was the potential for a lower high underneath that range to break this low, and oh my goodness, we're still in the thick of a volatile, uncertain market that could easily retest lows. The fact that the Tuesday reversal happened so quickly and the fact that we were back above this level, the 523.75, neutralized the short-term trend, right? From here to here, we had an equal low, but keep in mind that this is still undoubtedly a higher low relative to the capitulation low. So from here to here, higher low. From here to here, higher low. Now, the next phase of this, and as we acknowledged in the Wednesday midweek market update, was to say, okay, now that we've really failed the higher low at the ideal location, which would have been right here in the first place, right? If this was picture perfect for the bulls, it should have been a hold at 523, no looking back, equal high, breakout, and follow through. That didn't happen, but the equal low kept things somewhat neutral. If you recall, we sort of dubbed the term the tariff turmoil zone, which was between the two orange zones right here. 546.75 on the upside and 509.75 on the downside. You can see as of the Friday close, we actually broke out of the tariff turmoil zone, and we actually took out the high of the 90-day pause rally. That to me is starting to confirm more so that the bulls are actually making a stand here. The pattern that's in force could be some sort of higher low double bottom where you have low 1, low 2, somewhat over here, and we of course have broken the neckline. This is that nuance we were just talking about on the weekly over the 90-day pause high and the previous low. You know, let's not split hairs. It's still possible that a gap fill reversal up against this low could easily cause some sort of rejection. I would say that a threat to the base case here would be some sort of lower high underneath the 90-day pause high, the top end of the tariff turmoil zone, that produces a look above, and a failure via a lower high back in the range would be detrimental. Not detrimental, oh my goodness, the market's going to crash, but we should definitely keep an open mind about setting another daily high or low, potentially somewhere around the range of the gap close at 530, a slight overshoot of the lower edge of the weekly expected move. So all up, I would say that the daily trend here is flipping in the upward direction, right? Just to go back to that basic question of technical analysis, what is the trend? Where are we in the trend count? These are higher lows. This is the high. We've broken out technically. We've made a very nuanced higher high as of Friday's close, and therefore the daily trend can afford to pull back and set some sort of higher low. If we're reading into the candle structure here, I think it's noteworthy that on the Wednesday session, we actually saw an inverted hammer print. And of course, that was a partial gap close. We also know that Wednesday after the close, there was some more tariff turmoil with some uncertainty around, okay, what's the policy around China? What's going on here? And yet, on the Thursday session, we opened very close to what easily could have been a continued gap close and just a straight up rejection of the top of the tariff turmoil zone. And what happens, right? Technically, we have an inside bar on Thursday, but we rotate straight back up towards the highs and close pretty firmly. That, to me, is an indication that new sellers are not really willing to step up here and do, air quotes, what they should have done, which is close the gap, right? If we had stronger sellers, they should have had no issue rotating through this area of thin, basically non-existent, structure to the downside. So where does that leave us in terms of the daily analysis? What's going on here? What should we be paying attention to? Again, a little bit of continuation here to close the gap overhead to 554.85. This previous low would not seem unreasonable with Friday's strong close. If we see rejections there, we want to keep an open mind that the best possible outcome would be a pullback and a higher low to maintain the breakout of the tariff turmoil zone that's over 546.75. If the market pulls back beyond that, it's not the end of the world, but you should keep a very open mind to look above and fail. If that's the case, a lower high under 546.75 should come in, and it should target the full gap close at 530. When we get to 530, that's where I would be on the lookout for a DHL shipment. As you guys know, that is the daily higher low. If we can set a low, a daily higher low here, another daily higher low there, that would be looking pretty good for the opportunity for the buyers to step up and try to pressure once again the top of the tariff turmoil zone, and the continuation would look something like this. Ideally, with buyers on the daily timescale, weekly timescale, negating the weekly lower high, 550, 549.50, if you want to split hairs there. And then the ultimate target, the next upside target here is the top end of this range from back here, which is much closer to 569.75, a slight overshoot of the upper edge of the weekly expected move. Let's get a little bit more granular and let's drop it on down to the hourly time scale here. Let's see what else we can learn. So generally speaking, I think that the Monday session is worth continuing to read into, right? If we had, again, asterisk on the term if we had stronger sellers in the marketplace, you would have expected some kind of lower high opportunity here on the Tuesday morning session, rotate to the equal lows, and then a breakdown becomes pretty detrimental underneath the 509. Once again, none of this took place, which is why we're reading into the fact that stronger sellers are not stepping up, even among some of the continued tariff turmoil that we see in terms of policy. And I think that this just comes back to the MF-EU scale, right? So once again, for anybody who doesn't know, we'll go over it once, one time only. Max fear is over here, complacency is somewhere in the middle, and then we have euphoria somewhere over here. Little e, big U. That's how we get MF, EU on the scale. Max fear, we've already talked about, has been priced in over here. Every day that goes by where tariffs are not getting worse, every day that goes by where it seems as though the administration is walking back some of their stance on tariffs and alleviating some of the pressure on the trade war, the closer we get to complacency. As soon as a China deal is, and when and if, we should say, big emphasis on if, is announced, we probably move over here towards euphoria. And what would euphoria do? Probably cause further upside pressure in the market. So once again, given that we're probably somewhere along the lines of complacency right now, and we do not have stronger sellers because they did not provide that lower high underneath the bottom end of what was the do or die zone here. Recall those previous highs, right? Because that didn't happen, because sellers did not close the gap all the way, because sellers did not allow a rejection at the top end of the tariff turmoil zone, and we closed on Friday above that area, I would generally think that the buyers have the edge. That's the whole reason everything that we just walked through in terms of the psychological happenings and the failures of the sellers, that is why we are left with the weekly bullish engulfer, right? So on the hourly time scale, I think it's probably worth bringing out a Fibonacci from the low of the Monday move up to the high of the Friday move. And what we'll see here is actually quite interesting. If there's any pullback back into the tariff turmoil zone, it wouldn't be unreasonable to test and even close this gap. And as we know, it's very possible that a daily higher low could form around these areas. That would be respect of the 38.2 if we just bounce off the top of the gap. That would be very bullish, not closing it again on a second test of the area. And it would also classify as bull flag consolidation from this perspective here, if we're analyzing the move from point A up to the high of Friday, which of course could be called point B. If we go beyond that, I would even say that the 61.8, which is confluence with the old do or die level, the top end of these previous highs from back here, the area where we would have liked to see support on the first go around, the confluence there at 523.75 is also an argument for a daily higher low to be found around this area. So as long as the market on the S&Ps here does not move underneath, I would say that this is the line in the sand, right? as long as there's a daily higher low, potentially over 523.75, it seems as though we're trying to move in the upward direction more constructively. And keep in mind that the entire reason why we're still seeking the higher low, instead of just saying, it's balanced or it's going to fail again, is because the market broke out over the 90-day pause high. If we were just coming from an equal high here and we were getting a pullback, I would not be talking about being overly convinced about a higher low in the trend sequence. It really hinges upon the fact that we've seen the failure from the sellers, and also we're pulling back from a new higher high. So what does the pathing ultimately look like here? Well, before we get to the pathing, let's actually throw on our good friends, the anchored view apps from the intraday. Just keep in mind that this is the all-time high anchored view app from back over here, the solid white line. This is the 90-day pause anchored view app. This is the Monday fake out anchored view app. I think that this aligns with the analysis we've conducted so far, where if there's a failure back underneath, again, short term, something like an hourly lower high underneath 546.75 could easily come in and target the top of the gap, which is the lower edge of the weekly expected move, closer to 534.75. Notice that the anchored view apps may meet us there for confluence earlier on in the week. If we close the gap, depending on how exactly this anchored view app, this is the 90-day pause anchored view app, that's a little bit flatter of a slope down here, it may be closer to the 530 gap fill reversal. So what does this look like in terms of a pathing idea? Once again, close the gap overhead perhaps, lower high underneath 546.75. I'd be looking for this rotation here and then potentially to 530. If we get that, I would start to put my thinking cap on and say, okay, where is there some kind of reversal off of 530 with a higher low over 534.75 to rotate back up to the equal high target of the tariff turmoil zone, 546.75. And then beyond that, right, we would look for the market to move through, maybe set an equal high, and then some sort of pathing idea that offers a higher low over the zone as we walk forward. That would be constructive on the long side. The picture perfect outcome, where we don't even test this gap, would be something that looks like a gap close overhead, a pullback to 546.75, and then a rotation to the upside that looks like this, probably targeting some of these nuanced levels from off to the left. We have 561, and then up here, it's kind of tangled up with the upper edge of the weekly expected move. It's 566.25. I know it's probably hard to see behind the cyan line in there, but 566.25. That would be the top end of this rotation from off to the left. And then the ultimate target we talked about on the daily is at 569.75. If we were to get some sort of, Brigade bolt here, next target, go through, Brigade bolt there, then we're looking at that. Okay, that is the picture perfect bullish path. Of course, the other alternative is just that it finds acceptance over the top of the gap and rotates immediately up towards those highs on some sort of straight up continuation move. I would think that it wouldn't be unreasonable for the market to pull back and offer a higher low. That would be the healthiest thing, in my humble opinion, to happen here. Just noting that we do have a wall-to-wall move. We've come from the bottom end of the range straight to the top, breaking out on the Friday session without a major offering of an hourly higher low pullback. This was the only thing that we saw here, which was just the failure of the sellers to close the gap all the way in the first place. And that's not really coming from a higher high. That was coming from equal highs. So at that point, the trend was more so neutral, right? That's what we have here on the hourly. Once again, if the market's going to go to hell in a handbasket, it's probably straight up opening drive here, closes the gap, lower high under the Wednesday low, some kind of rotation into 523.75 that continues to accept down here. Then the Brigade bolt, this lower high there, that's kind of the nail in the coffin for maintaining the opportunity for a daily higher low, which preserves the bull case, right? So those are the levels, those are the ideas that I would be thinking about. If you said, what's the one that you would be focused on? I would primarily think about this as being, if I could only choose one pathing idea, this would kind of be what I would like to see from the market. Doesn't mean that we're going to get that, but I would really be interested in participating on the higher low here, the gap fill reversal here, and perhaps even the short to get from, let's just label this, point A to point B, and then maybe C, the gap close as a potential early week short for a pullback to establish that daily higher low. So that's where my head's at in the S&P 500, but undoubtedly we're seeing the failure from the sellers here on Monday. We're seeing a partial gap close, another failure from the sellers, and no rejection at the top end of the tariff turmoil zone. As a matter of fact, let's get crazy here. As I zoom in real close, you can see into the afternoon session on Friday that the top end of the tariff turmoil zone actually acted as support in the lower wick of that hourly bar. Let's take a look at the market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What do we see? I mean, on Monday's session, let's once again fully acknowledge it was undoubtedly bearish. Look at this cumulative build down here as well. Brutal session on Monday. If I had to go back in time and do the same exact analysis, I probably would conduct it the same exact way. As we look at the remainder of the week, though, look at how the cumulative volume actually closes out on the week. It's actually up and over 600 million, which is a not decent, that is the substantial high watermark, right? So solid volume flows, huge inflows on the Tuesday session, Wednesday getting substantial, Thursday getting substantial, Friday on the consolidation and follow through, kind of neutral here at minimum, just not getting negative. As you look at the advanced decline line, big buy signals out there. And of course, this has a lot to do with the breadth thrust signal that we saw earlier on in today's episode. As we look at the cumulative builds, so they're okay. I'd say Thursday was pretty meaningful on the sustained grind in the upward direction. That truly was a grinder of a session. And then Friday is flat. So why was I talking about perhaps maybe the first pathing idea that comes to mind being maybe some sort of continuation that fades, something that looks like this? Well, if we think about, is the market exhausted up here towards these highs, certainly starts to feel a little bit that way when the tick is not really sustaining strong builds through the session on that Friday move. Volume's a little bit more muted, and we actually just close at the zero line out of the advanced decliner. As we take a look at the market profile, let's jump on over here. Any nuances out of the market profile? Generally speaking, I would just say that the fact that this poor low, and once again the gap did not close on that Wednesday and then Thursday's follow-up, is very substantial. You can see that A period opens, maybe you can't see it on your screen, but that's the opening print of the Thursday session. We come in and test the low of the prior day, which is a poor low. In theory, a test of that should lead to a break, and it just didn't happen. So the continued takeaway for me is, do we have stronger sellers? The answer is a resounding no. As we think about the structure on the Friday session here, this is the Russell. I'm just realizing. I'm like, hang on a second. This doesn't look right. This is the Russell. Let's go to the ES. It's the same concept, right? So please don't, it's okay that we said the same thing. Notice, here's the unfilled gap. Here's the open of A period. There's the test of the previous lows at the lows of A period here. No breakdown, right? Notice that the value area on the Thursday session migrates higher in the individual session, and the point of control is clean to the upside out of the Wednesday session. Again, if stronger sellers were going to capitalize on this weak close from Wednesday, you would think that this gap should have closed no problem. Again, the takeaway is the exact same, even though we started on the Russell market profile. But as we can see here with the follow through out of the Friday session, the point of control is left higher in the profile. It's an extremely poor high. Let's take a look at that. Really just lack of material excess here on the highs of the Friday session. So what would that imply? Again, there's a reason why I said that my base case is a break first, then some sort of thing that looks like this for that downside pullback, right? The logic behind that is repair the poor high, close the gap overhead, which we saw in the price charts, and then put this point of control off sides. Anybody who is initiating new money longs at the high of Friday session, let's trap those traders, offer a pullback, and allow a daily higher low where stronger, more convicted longs can participate off of that potential inflection point, right? So that's the market profile in a nutshell. Let's jump back on over to the platform here. Let's take a look at our good friend, the nasty NASDAQ on the weekly time frame chart. Let's jump on over to the Qs, weekly time scale, and let's take a look at the NASDAQ. So candle structure and location, just like the S&P 500. What do we see here? It's very similar. I would say actually that the body of this bar is larger than what we have relative to the wick, at least, than the S&P 500. So solid green bodied bar, strong close towards the highs. It is definitely a bullish engulfer where we've closed over the previous week's high. And also, let's just do like a follow-up from last week's analysis, right? If we just label the red bar number 1, that's a bullish inside 3-bar play, right? So following through over the inside bar high is actually triggering a bullish indication here, looking for follow through in the upward direction. So structure and location, both bullish. As we think about the overarching trend, it's still down, highs, lower highs. Threat for a lower high in here has been taken out a little bit more substantially out of the NASDAQ. We'll see that more precisely on the daily time scale in just a moment. I also would be a believer that from here, let's grab the square, from here to here, we could be offering a daily higher low and a weekly higher low at the same exact time, just once again referencing the magnitude of these ranges down here. As we bring out the Fibonacci's from the all-time high to the low of the move, we are over the Fib 38.2 after the breakdown on Monday brought us firmly underneath, right? As we take a look at from the lower high to the lowest low, once again, Monday taking us under the 38.2, yet closing the week up here well above the Fib 61.8. Odds would increase for a 100% retracement the more weekly bars that close above. So far, so good, and starting to see signs of green shoots even on the higher time frame weekly. As we take a look at the anchored VWAPs on the weekly time scale, similar story to the S&P 500, whereas we anchor from here and here, that held as support, we've closed above, and we've even closed above the all-time high anchored VWAP, which is something that we had not done or seen over in the S&P 500. Let's take a look at our good friend, the volume profile on the weekly, well above this high volume node. Let's check in on this one though. You can see that that is still looming overhead. So as we're thinking about the opportunity of a lower high threat out of something like the NASDAQ, it might be more beneficial to focus on a level which is somewhere closer to 483. 483. That way we have highs, lower highs. You'd get a very nuanced lower high if this high volume node rejects. It's something that we'll keep an open mind to as we walk forward through the week. Let's drop it back down to the daily time frame chart. Let's firstly evaluate this week's expected move. It is, again, the gray box right here. And if we're looking at the upper bound, the number's at 488.35. That, of course, is a higher high in the trend count. If we are contained by the lower bound, it is at 456.80, which as well is a higher low. So bullish on the weekly expected move. As we're thinking about the overarching trend of the daily time scale, let's zoom in a little bit further, we still have the main base case, which is that the capitulation low has transitioned into a structural low, with these acting as, there's some, again, I think the analysis of Monday, the emergency meeting, justified in the sense that you actually made a lower low relative to this previous low on the NASDAQ. And it's not such a clean balance range in here. I mean, we've done our best to sort of label that as 430, 465 up to 465.85. However, the overshoot was somewhat substantial. The fact that this can now act as a potential higher low is on the table because we know that for a daily higher low to be produced, we ultimately need an hourly downtrend, which we did get in this zone. And it's, without saying, we of course have broken, if we take this and this is a higher low, this as a double bottom, we are over the neckline, undoubtedly, much more firmly, even breaking on the Thursday session over the 90-day pause high and getting even more follow-through on Friday versus what the S&P did, which was just a small trickle in the upward direction. So the NASDAQ being a slightly more risk, the risk appetite of the NASDAQ is higher than the S&P 500, which could be slightly more diversified in the S&P 500 versus the NASDAQ 100, not so concentrated just in tech. This is a risk-on indication, I would have to say, making that move and the follow-through, the extra follow-through on Friday over the 90-day pause high. Something we didn't really talk about over in the S&P 500, but we can do the same trend line. It's fine. We can jump over there real quick just for an apples-to-apples comparison. Remember on Wednesday we talked about, okay, we're at the resistance trend line. It's possible that a move, especially with the Wednesday after-hours news, we could close the gap. That didn't take place on Thursday. We got much more of a meaningful daily close over the resistance trend line and follow-through on the Friday session as well. Just to be completely congruent in the analysis, let's go on over to the S&P 500 and let's take a look at the trend line here. And as you can see, the rejection was a little bit cleaner. Again, I'm not the biggest fan of trend lines, but the fact that it aligned with a horizontal was great. So Wednesday's rejection was cleaner of the trend line, undoubtedly, on that Friday session. Even Thursday, we've closed up and over the resistance trend line there. So that is in play. Same thing happening here, excuse me, over in the NASDAQ. And I think that for the most part, the analysis is very similar to the S&P, where the ideal thing to happen would be any sort of pullback over the weekly lower high threat and the 90-day pause high at 465.85. It's a great opportunity for the most pristine higher low. Our target would be the equal high from Friday, and then we would just walk up the next target to 480. Beyond that, we have the major target, which comes from these equal highs, acted as support, then resistance here, very clean level on the hourly that we'll see in just a second at 485. That's not as much of an extension through the upper edge of the weekly expected move compared to what we were looking at in the S&P 500. The other thing that you'll note here is that the 90-day pause, and we talked about this as soon as it happened, already closed the overhead gap, whereas the S&P 500 is still contending with some of that gap overhead based on Friday's rotation to the upside. So that's 465.85. That'll be a top watch here. If we do get the lower high back down underneath, keep in mind that it's still possible. You go higher low on the daily. You could get another higher low on the gap fill reversal here at 447.25. As we've explored just a moment ago, the NASDAQ apparently, at least in recent times, likes to give a little bit of an overshoot. Would it be unreasonable to overshoot the gap close and still yield a higher low at 441? I think it's a possibility. As we take a look at the hourly time scale chart, what can we learn from here? Once again, if we had stronger sellers, we can walk through the same thing. If we had stronger sellers, Tuesday should have yielded a lower high here, equal low, and then breakdown. Oh my goodness, it's the end of the world. Didn't happen. We know that this yielded instead inverted head and shoulders. We gapped up over the neckline. Stronger sellers should have closed the gap. Didn't happen. That's strike 2. Strike 3 is the failed rejection off the top end of the tariff turmoil zone at the 465.85 90-day pause high, which you can see offered some resistance here, and resistance here. Friday says no problem. We're just going to continue to grind in the upward direction. So once again, all things considered, sellers do not really have much of an upper hand here. As we bring out the Fibonacci's from low to high, not the best confluence. The S&P is definitely a little bit cleaner. I would generally just read into the idea that the 61.8 line in the sand for that higher low relative to the move as measured from point A to point B wants to be somewhere near the gap fill reversal around 447.25. So what does the pathing look like here? Probably very similar to the S&P, where something that looks like this is reasonable. If we can support 453, great. This would be okay. Looking for 485 on the upswing on the higher low back out of the tariff turmoil zone. If we do come in and close the gap all the way, I would love to see a higher low back over 453 to then participate on this higher low. I'm drawing it over confluence with that path right here for the move back in the upward direction. That's also solid. If the market's going to say, nope, try again, this is just nothing more than a look above and fail, which keep in mind could be the case, not just for a pullback higher low, but look above and fail that completely fails. Let's say the gap fill reversal fails, another lower high, in theory would target the bottom end of the range. I would say that that's a back pocket idea as of right now. That's not the higher probability outcome based on some of the additional indications we'll see in today's episode. However, bulls, right? We already talked about it. Just consolidation here is nothing more than a very short-term hourly bull flag, possibly getting Brigade bolts over 473, target 480, 485 is that ultimate upside target. Keep in mind too, we didn't really acknowledge this on the S&P, but it is there as well. The daily 50 SMA could act as a meaningful rejection on the first test, just noting that we haven't tested it in quite some time. It's been a little while since we've interacted with that 50. Here you can see, based on the previous level, that's why 485, right? Previous rejection acted as support. Very, very clean level there. And you can see that the sort of midpoints, if you will, as we divide this range into thirds, really comes from this pullback on that individual day. So just giving you the justification for the levels that we have above us. Let's take a look at the anchored view app set intraday. See what we can learn here. We're again over the all-time high anchored view app here, confluent. So not unreasonable that this might be an outcome in the trade here, could be something worth entertaining. 473 into 480 and then beyond that 485. If we're looking at a failure, again, something that does this, top of the gap seems to be a little bit more impressive with better confluence out of both anchored view apps from the 90-day pause as well as the Monday fake out with the breakdown happening there. If we do see the capitulation anchored view app in play, that's much closer to the 441, which as we know is the absolute line in the sand for our daily higher low argument. Let's move on over to the market internal side of the NASDAQ. As we take a look over here, it's a rinse and repeat of the S&P, where Monday, again, I would absolutely maintain the same analysis that we conducted, which was, wow, stronger sellers stepped up and they actually took out the previous low on the NASDAQ on really strong bearish internals. Well, look at what happened into the remainder of the week. Really strong inflows almost every single day outside of Friday, so 3. Strong inflows over 400 million. In here, we're generally looking for 6 to 750. We got 1 billion, right? And this is... It's technically measured in shares, so you could say 1.6 billion shares flowing into up stocks versus down stocks net on the week is definitely more of an impressive metric to the upside. Out of the NASDAQ volume flow wise, that's this metric right here, the number in that box. It's what this is measuring there. As we take a look at the advanced decline line, really strong, up in trend higher zone the same 3 days, closing neutral on Friday as we got follow through once again. Is it unreasonable for the pullback first based on this? I don't think so. Based on this, pretty flat out of the cumulative build on Friday. Is the market coming into a short-term exhaustion? Something that would allow for a higher low pullback to then scout longs in this zone. I think the evidence supports that being a reasonable thesis as of right now. Let's jump on into the NQ. This time I promise we're on the right market profile. By the way, if you're not familiar with market profile, check out the video tutorial in the top right-hand corner. As we're taking a look at the value area, it's just consistently progressed in the upward direction. Here's Monday, Tuesday, and you could say the same thing about the S&P, of course. So just slightly different analysis on the market profile. The only difference is here that the point of control on Friday is not slammed up towards the highs. You have a much poorer low. You do have lack of material excess at the highs. So similar story in the sense that if we were to put this point of control off sides, that's where that pullback comes into play. And I would be thinking about this gap range down here being your daily higher low zone on the repair of this poor low, rotating maybe through some of this thin structure from A period, and sort of then seeking whether or not this is dubbed fair value from buyers, and if they step up closer to somewhere around 18.7. That's the top of the gap on the NQ futures. Let's jump back on over to the platform. Let's finish up our big three indexes with, of course, none other than our good friend, the IWM small caps. What's going on over here? Let's go to a weekly chart first. There we go. And let's clean up the drawing set just so we can see things here clearly. And let's actually bring this to a 5-year chart will do. 5 years will do. So let's start with candle structure and location. Bullish engulfing bar, absolutely. Breaking the inside bar high. Breaking the container bar high. Closing strong up towards the highs. We have a little bit of a lower wick indicating buyers stepping up there. Same indications as the other charts. However, we know that the general risk for a small caps lower high is much, much greater. Why is that? Because this level here, 198 to about 200, treat it as a 2-point zone, is a huge monster threat. We have previous highs, previous highs, previous highs, previous rejection here acting as support. Weekly 200 SMA, previous low. It's a danger zone. So 198 to 200 has not fully been recaptured. My first thought would be that the market should pull back from that level because of how substantial it is. The key question just becomes, do we set some sort of weekly higher low if a pullback emerges? Now, of course, if the market opens on Monday and says, pullback, what are you talking about? And we get a weekly bar that starts looking like this over 200, then would take that as new information, right? I'm not really a Russell trader, rather using this as a bellwether gauge for the broad market. That, of course, would align more so with the bull thesis we've set forth so far in the S&P 500, and also looking for that breadth thrust to broaden out into other aspects of the market, not just the highly concentrated tech stocks in the NASDAQ 100, let's say. So we'll take that as a sign if it happens, but the first thought, I would think, is a rejection of this 198 weekly 200 SMA, and literally the 200 round number out of price itself. As we zoom in and take a look at the Fibonacci's, let's come in from the lower high here first to the lows. Notice that we're under the 61.8 instead of the S&P and NASDAQ, which closed above. If we take that off, come in from this lower high to the lowest low, still at the Fib 38.2, not really seeing a compelling argument there. And of course, from the all-time high to the low, you're getting confluence out of the Fib 38.2 with the weekly 200, the 200 figure, and all of the resistance that we just talked about. So there's much more work that needs to be done here out of small caps if you're going to build a similar bullish argument. If we throw on the anchored VWAPs out of the weekly set here, you can also see, let me just zoom out so you can see the origin of all of them. The low after the major drawdown of 2022, also the previous all-time high anchored VWAP, is still acting as resistance. We're not above either of those. You can see that there's a lot of overhead resistance based on these also coming from our new all-time high, the lower high happening here, and even this low before the rally in the upward direction. So a lot of overhead threats here out of small caps, which is something that is worth continuing to pay attention to in the context of trying to scout a stronger bottom in the S&P itself. Let's take a look at our good friend, the volume profile, see what else we can learn about small caps here. Notice that we have this high volume node, we have this high volume node, and that's sort of right around the sweet spot for that big time lower high that we've been talking about thus far. I will give a little bit of credit where credit is due and say, okay, the market did test underneath this high volume node. Sellers were unable to accept below, and we closed above. So you've got that going for you, but still, this threat overhead is, as I'm sure you can tell, based on the amount of times we've referenced it, It's a big deal. $200 out of IWM, big hurdle if this is going to improve as a technical chart. Let's take a look at the daily time scale. Let's see what's going on from the weekly expected move point of view. Here it is in this box right here, $200.42 on the upswing, indicating a higher high. And the lower bound is at 188. It's perfect confluence with the gap fill. That also would produce a higher low. So the expected move is still bullish here. We will call the shots as they lie. The daily chart is also in a much, I wouldn't say better uptrend, but I am somewhat impressed just by the nature of the market spending more time over the 90-day pause high for the back half of the week versus the S&P and the NASDAQ, which really only broke out over the highs on Thursday late day, and then Friday, of course, getting a little bit more of that follow through. All inside bars here into the end of the week on the Russell after the Wednesday gap up, so not much to read into in terms of the individual candle structure happening here. You would treat that as a 3-day balance range. If you break out of it, you're just headed straight into that major resistance overhead. Daily 50 SMA, upper edge of the weekly expected move, weekly resistance around 200, 198, you can see is labeled as the major lower high. So even on a range breakout where you would in theory try to double that range in the upward direction just based on a quick visual, that would be the measured move, you're running straight into resistance. So it really becomes a question of early on in the week, what does the breakout look like? Is it strong green-bodied bars that look something like this? If that's the case, great confidence for our S&P 500. If they're really meager looking bars, let's just say that we get bars that look like this, big upper wick on the candle. Let's just say that maybe the next day gaps up, but then fades right back down towards the range high. That starts to become a little bit less compelling, and you would just say, okay, sellers are stepping up at the major weekly level, probably not compelling for a stronger long argument over in the S&P 500, maybe a little bit more neutral or even that pullback argument for the daily higher low. If the small caps are going to pull back for a daily higher low, your gap fill reversal once again is confluence with the lower edge of the weekly expected move 188, a breakdown of this range and then a range double probably brings you closer to this previous range, which would kind of be detrimental here. The best thing that if the market pulls back you would want to see out of the small caps is a firm gap fill reversal out of 188, higher low over 190 to just preserve a little bit more of that bullish tone here in the short term. Anything that's underneath 188, pretty tough, right? This would just start looking like a failed breakout of this. You could label this as the overall range. This is the range within the range, if you will. Trying to break out, if you can't hold the gap fill reversal for something that looks like that, then it's danger, right? It is danger that you're accepting here, lower highs here, and then you've really made no progress out of small caps. It's much more of a neutral balance than any sort of supporting evidence on the long side for, once again, our good friend the S&P 500. So those are the levels, those are the numbers. Let's take a look at the hourly time scale here. Just for the sake of congruency, we'll come in from the low up to the high with the the Fibonacci's. Fib 38.2 at the top of the gap, 50% on the gap close, 61.8 is a slight overshoot, probably don't want to go there, 188 would still be my key line in the sand. You can see once again that this is nothing more than a multi-day balance range happening here, so no bold predictions until we can break that range. Then of course, in terms of the anchored view apps, we're over the cluster. I do like that this is confluence over the 190, so if we can just support this as a range, let's say that the market pulls back early in the week and supports 190, probably helps the case for longs over in S&P 500, in the S&P 500, excuse me. And then the all-time high, excuse me, anchored view app break would have to get us, even that is just, you're running head first into that major weekly resistance. So to me, it's all about gauging the reaction of small caps in this zone up here if there is going to be a constructive breakout in the first place. Let's get on over to the Russell side of the market internals. Let's see what's happening from this point of view. You can see that we do have substantial volume inflows. We're looking at 250 usually out of the Russell. It's always going to be much less than the S&P. So still substantial here with 3 days getting, firstly over, then very close to trend higher zone neutral still on that Friday session. You can see the same thing here in the advanced decline line, not quite over zero on Friday. And then our builds out of the cumulative, not so compelling on the Wednesday. Obviously, that was the day where the market faded off. But even on Thursday, not really a strong build. Friday's pretty neutral to weak there also. Again, small caps, although the location, as we just go back here, is over the high of this move, it's not really an exchange, but at the internals level for the index, you're not seeing a lot of follow through after that Wednesday move to the upside. So again, still a similar argument. Stronger sellers should have yielded a lower high here. Stronger sellers should have closed the gap all the way. That didn't happen. but a little bit weaker than the other indications. So if you're looking for longs out there right now, I would generally say that the NASDAQ probably has the most strength based on what we've seen. Then I would go S&P, and IWM is probably a back burner as of right now. Let's jump on into the Russell, which we already got a sneak preview of. Here's the inside bars, right? As you can see, those inside bars are taking place. Point of control migrates from the low point to the mid-ish, maybe upper third, lower edge of the upper third, straight to the midpoint of the range on the Friday session. Once again, a very balanced market out of small caps. I would not make bold calls in there until we get out of the range over 1980 or underneath 1920 to potentially close the gap into something like 1905, and that would be your key area out of the Russell futures. Let's jump back on over to the platform here and let's take a look through our S&P sectors, who was leading, who was losing, and where was the weight this week. Sneaky towards the bottom here is the semiconductors ETF, not a sector, but up 12.21%. Absolutely incredible. Big move out of semiconductors. It is a big improvement structurally, as we'll see on the chart in just a moment. So I like that. And then we see the XLK, the XLY, XLC. All of these are heavier weight risk on style sectors, which is great to see towards the top of the list. Even if we go, let's just go beyond that. Industrials, slightly more risk on. Financials, absolutely risk on. Energy, a little bit more neutral. The bond, not so risk on. But then it's materials, the most lightweight. Then we have defensive healthcare, which is still green, don't get me wrong. It's positive. Anything, upside pressure is upside pressure for the market. Then it's real estate. Then it's utilities. The only red name in terms of the sectors on the weekly performance is going to be your XLP, which is consumer staples, and that is D for defensive. So as the market's attempting to break out of this balance range here, the tariff turmoil zone as we've dubbed it, that's trademarked, by the way, do we see a risk on rotation as the attempted breakout's taking place? The answer is absolutely. That is helping the bull case here as we're moving out of the zone. Let's check in on these structural charts and see what's going on. I love the fact that the XLK, the heaviest weight component of the S&P, is not showing any signs of rejection or slowing down at the big threat level of 206.40. I like the fact that this gap remains unfilled. I like the fact that once we overshot the level here at 190.75, there was no looking back and it was straight to the upside. So really nothing overly concerning about the XLK, and as a matter of fact, really strong improvements and developments with this move to close on Friday up and over the 206.40. Does it mean we can pull back and offer a higher low? Absolutely. At this point, we would be pulling back from the highest high in the trend count. As we look at the XLY, a similar story over here, where you'll notice the previous bottom end, the weekly threat, if you will, has been broken out above. We certainly struggled a little bit with the upper wick on the Wednesday session, but Thursday, Friday, straight back to the upside and closing above. Now, once again, we certainly have the opportunity for consolidation here, a pullback to stay above, something that looks like this, much more constructive in the upward direction. I would even go so far as saying if we could get a higher low over the do or die zone at 188, something that looks like this, still in play for the bulls to be in control. Lows, higher lows in the trend count. And I think what we'll see when we get to that volatility indication, which I know we mentioned it way in the intro, is we're probably not in store for a V-shaped recovery here. We're probably in store for a slow grind in the upward direction as the market just holds its breath, right? There's always the possibility that a new tweet or a new this or a new that throws things off, and I think the market's going to grind because of that, but for the most part, structure has improved dramatically here. XLC, not all the way there. Obviously, our neckline is as clear as day at 95. You got to get up and over that for things to become a little bit more constructive, but again, the failure early on in the week here underneath the 91 was concerning. Now we have the offering of a potential higher low if the grind is going to continue. So at this point, if we're looking for these structural higher lows to stick, you cannot see the XLC underneath 91. Let's move along to the XLI. Similar story here, where we're now over the key level at 128.50. I would not want to see an equal low back down here at 122.50, so maybe something like a gap close, which is closer to 125.25, we'll say, for the sake of round numbers. I'll quickly make that yellow. We won't put the top of the gap in, but you get the idea. A pullback here, that would be your constructive look for the upside. I do like the fact that we are pulling back or have the opportunity to pull back from a higher high. So definitely improvements here. We were talking about threats earlier in the week at these sector level charts. Now we're talking about pretty substantial improvements. The XLF looks really good. It has looked good for a while now. I love the fact that this consolidation is happening over the neckline of what could be considered the higher low double bottom. So 47.60 continues to hold. Daily 200 SMA in there, getting a little bit of a pinch here between the two key moving averages. Consolidation that resolves higher will be bullish pressure for our good friend, the S&P. Let's take a look at energy. Really not much going on here, but if it does break out and close the gap overhead, I think, not that we would put to bed all of these concerns about recession we've been talking about, because it doesn't just go away in the blink of an eye. but it would start to indicate like maybe not as much concern about a deep, dark, dirty recession where, oh my goodness, everything's going to go to zero. So watching to see if energy can catch a little bit of a rebound here. Let's check in on crude. We know that there's that lower high threat for the Brigade Bolt still here, right around that 65-ish zone. So that's still in play, something that we will carry forward on the charts here. We would like to see some improvement out of that up and over the level, but at the sector level for the S&P, definitely a little bit, if you were to ask me, okay, what's this pattern here? I mean, come on, you've got a trend line there, you've got this ascending triangle, someone might call it a bear pennant like that. I would think if you squeeze the shorts out of the bear pennant, you're probably looking at the gap close, right? So really watching that 82.85. It's a lightweight sector, though, so let's move on. TLT, the pattern is not so clear. This is sloppy, if anything, and this continues to be volatile because of likely the comments about Jerome Powell, about the Fed. Are we going to get a new Fed president? Is there going to try to be some removal of the Fed chair, or will things just remain peaceful? So there's some of that uncertainty happening here in the TLT. So I don't love the chart pattern. It's all over the place. Maybe you could call it a double bottom. Maybe we're over the neckline here, 88.25. I would remain really neutral. I would really just start thinking about this as a range. This is the midpoint of that range, and there's really no edge there. So not every chart needs to always be telling you like, hey, this is the setup, this is what's going on. It's okay to just say like, okay, there's really no clean, well-defined move out of the TLT, so let's just avoid in that range, right? So avoid, sometimes no trade, right, is the best trade. Let's take a look at the XLB. Materials here are trying to get up and over that level. I like the fact that this is broken out over that. Let's take a look at the XHB, though, because as we know, home builders probably still lagging. Yeah, still offering that lower high here. Cyclical side of the economy not really coming back yet, or at least in terms of price action, it's not. So I'd be still somewhat on edge about that, continuing to monitor the XHB. Healthcare as a defensive sector is not broken out yet. I would think if the market pulls back, and this is where we start talking about rotation, rotation is what makes a healthy market. Absolutely. So let's think about this. What did I just say is maybe reasonable about the S&P 500? Close the gap above, lower high in range, some sort of pullback to maybe close the lower gap and offer a daily higher low, right? DHL shipment. If that's the case, we probably see the tech sector pull back from their local highs as we just saw, and we get some sort of pullback on those names. If the healthcare sector as a laggard can break out as that pullback is taking place, it's going to prevent the S&P from falling literally into free fall, and that rotation is going to start indicating a healthier market. So really watching out for that if that unfolds that way this upcoming week. It's definitely a scenario that I'm prepared to evaluate and say, okay, this is giving me more or less confidence on the pullback, right? Let's take a look at the SMH semiconductors. This is at the do or die zone, excuse me, the high at 211 here. I do like the fact that the overshoot did not yield a lower high, right? So put yourself in the shoes of a trend follower, and what in theory could happen here? You get an overshoot. Technically, this is a lower low. A lower high is the next nail in the coffin to confirm a new downtrend. The fact that we've made it to the equal highs in relatively short order is a little bit more compelling that the sellers do not have what it takes to push prices lower. So at this point, equal high pullback, again, is fine. You would need to offer a higher low, ideally over the top of the gap. In theory, if you close the gap all the way, it's not the end of the world, but it really wouldn't be as clean. It's a little bit deeper than what I would like to see at 193. Let's move into real estate, defensive hard asset, you could say, rejecting towards the neckline of maybe this as a head and shoulders. Not overly concerned. $41 there is your major pivot. It's a lightweight sector, so let's move along. Utilities, also a really lightweight sector, not outperforming, but just still stuck sideways in this range, midpoint. Not much to say about that. And consumer staples here, perhaps in a bull flag, right? You could call this bull flag. You could call it daily hammer there. If, again, we're talking about this rotation thesis, and let's just say that, oops, weird zoom there. If we get the breakout of XLP over the hammer high, or just over the top end of this range in here at 82, that could be what it takes to offer the rotation as tech pulls back and not sink the ship in the S&P 500. So the chart really doesn't look bad here out of the XLP. Yeah, it underperformed on the week, but in theory, you have massive lows, higher lows happening here, or equal lows, you could even say. V-shaped recovery, bull flag, call it, higher low like that. Whatever you want to call it, the chart structure is not bad by any stretch of the imagination. So 82, top watch. Will the rotation take place is the key question. Let's move on into our sector ratios here. Let's get a little bit more granular. If you're not familiar with the sector ratio grid or how to set this up, check out the video tutorial in the top right-hand corner. And let's just say the green shoots, they're shooting. If we look at the XLK, notice that not only did we sustain the higher low here, but into the end of the week, we actually went on to produce a higher high. This is a trend reversal out of the XLK ratio, which is a risk on indication. As we look at the XLY, the higher low is holding, and we've traded just a hair short of the equal high. If this can break out early in the coming weeks worth of trade, that would be very impressive. I'm honestly a little surprised that this didn't happen with the massive outperformance from Tesla on the Friday session, but we'll take that, in stride. XLF pulling back has the opportunity to offer a higher low, noting that we are pulling back from a higher high in the trend count. We'll give a check mark here as well. XLV is D for defensive. It's technically making an equal/slightly lower low. Not the end of the world, not overly concerned. As we look at the risk-off ratios, these are pulling back, and they're making higher lows still. Higher lows happening still here in the XLU. We're keeping an open mind to these, but as we're seeing the green shoots in the risk on sectors up above, I think that's, the next thing to watch out for here is a lower high out of these ratios. That would confirm more of the risk on rotation, confirming more of the structural low being in place and risk appetite across the market improving. As we look at some specialized ratios here, XLK SHY, you could see that we have the same story, higher low and also a break of the neckline here. You could see this as a double bottom. Neckline is in play as soon as Monday of this upcoming week. As we take a look at the XLY XLP, strong move to the equal high. A higher high over the 50 SMA would then easily set the opportunity for a higher low, and that would be a risk on rotation. Clear higher low out of semis versus healthcare, breaking out over the neckline into the end of the week, looking for a continued move over the 50 SMA, and even the ARK K fund down here, breaking out of, we talked about it slightly on Wednesday, this really odd looking inverted head and shoulders there, well above the neckline, but most importantly, breaching up and through the downward sloping 50 SMA. Let's take a look at the secondary set of risk on off ratios. Gold is pulling back. Well, I should say gold itself is absolutely pulling back, but relative to the performance, the ratio line pulling back indicates a little bit less of that flight to safety or just the sheer outperformance of gold and oh my goodness, let's buy this. So I think one of the things you want to be careful of there is anybody who's still looking to buy gold as an asset that's going to outperform might want to be a little bit cautious of that. There's actually a really great argument to be made. Let's maximize this and let's go out to a multi-year chart. If you take a look at this, right, and let's just use some horizontal resistance here, this area generally has provided a pretty severe reaction to the downside, and just noting the velocity, so to speak, of how we've arrived at this territory, wouldn't be unreasonable that a pullback here just kind of marks the end of the euphoric move out of gold, especially if you tie that into a lot of the other indications we've talked about so far through the broad market analysis. It doesn't look like the max fear, oh my goodness, let's rush into the safe haven assets, doesn't look like we're still at that point in the market. Once again, if you think about the MFEU scale, probably moving more towards the right of that scale rather than the left. So you think about Bitcoin, Bitcoin also breaking back up and over 92,000, a green shoot here as well out of the Saylor Schiff ratio, indicating that as gold is pulling back, Bitcoin is undoubtedly outperforming as a risk on asset. As we look at the TLT ratio to the S&P, I love the lower high, but we still don't have that final shoe to drop, which is the lower low underneath the ratio lows from back over here. Still watching that very closely out of the TLT. Let's move into some of the dollar and see what's going on with dollar and rates, a little bit more fundamental here. Dollar's trying to find a little bit of a floor. I think that this is taking place as the comments are, being relieved, so to speak, around Jerome Powell and his position at the Fed. You can see that rates here are going a little bit sideways towards the bottom end of their range. It doesn't seem as though we have any the volatility out of rates, right? We could even fire up, let's drop in up here, the move. I think we have to go GIF, yeah. Move GIF. So this is the bond market volatility metrics. This is the VIX of the bond market. Big pullback over here just indicates probably some more level-headedness out of interest rates, which is better for a bullish market, right? Obviously, uncertainty on interest rates. Whoa, what's going on? Flight to safety, money comes out of equities, more difficult operating environment. As this comes down, sigh of relief, a little bit more bullish, right? The max fear, so to speak, is in the rear view, at least in terms of bond volatility as seen here. Let's jump on over to, we could take a look at gold in isolation, just the chart itself. Notice the shooting star here on a big push to the upside. If this sets some kind of lower high, I think an easy target out of gold would just be back towards $3,200 an ounce here as the ratio pulls back as well. Let's move into commodities as a whole. I mean, we could just look at metals here. Many other metals are much more range bound relative to gold, which has clearly been outperforming there. So any big indications from commodities? Probably not on a relative basis to the broad market. Let's jump on into the inverted ZT as we anticipate the Fed tracker tool here. Unchanged, really not much going on sideways, which I think is a great segue. Let's just jump on over into it and see what's going on with the Fed Watch tool. Let's see, give this a little refresh perhaps. See if the Fed, there we go. Let's jump on into probabilities, and let me zoom in on this for you so we're not squinting at the screen here. Even one more. There we go. Looks like we are still dealing with 89.6% odds. This has been bouncing back between anywhere from 85 to 93% odds. I've seen it as high as for the May meeting, which is fine. We all know that the conversation here is that the Fed is going to continue to pause until the tariff inflation starts showing up in the numbers, which is going to mean at least waiting for April's data, which comes out in May. May's data comes out in June, so on and so forth. So you're probably not looking at a Fed. I would even say that the June Fed cut is a little bit shaky at this point. I would tend to think that the odds might bounce higher for a sustained pause if there's any inkling of an uptick out of inflation, which, as a matter of fact, we're going to be getting inflation data on Wednesday at 10 a.m. This week. So anyhow, how many cuts into the end of the year is something that we can continue to monitor. 1, 2, 3, 4. Still expecting the Fed to intervene. At least the bond market's pricing that in as of right now. I wouldn't be surprised if this actually turns into less than that. Let's jump on into the the economic calendar rather. Monday is quiet. All is quiet on the Western front. Nothing to worry about on Monday, which is pretty solid, but it gets funky into the remainder of the week. It's the labor report week. You can see that we have JOLTS coming out on Tuesday morning at the 10 o'clock time frame. Be prepared for that. It's the first taste of the labor information. On Wednesday, 8:15, we have the ADP non-farm preview. We are looking for 123,000, previous at 155. We'll watch out for any revisions there as well. GDP numbers get released at the 8:30 time frame. Looking for those to possibly cause some pre-market volatility. Of course, we'll cover that in the pre-market prep when we're all up in the office together. What we unfortunately can't cover while we're together is Wednesday, April 30th, 10 o'clock, PCE as the markets open. That's historically a 8:30 announcement. Someone fill me in the comments section. What's going on with that? But PCE, we're watching out for it. As of right now, the forecast is for a very mild read here at a 0.1 on the month-over-month core. We'll do our best to break it down intraday, but please just understand any hot readings here, and the market is probably not going to like that. Just noting that, and it shouldn't be hot, right? The PCE should be a combination basically of what we've already seen from CPI and PPI this month, so it shouldn't really contain any new groundbreaking news. But something hotter than the expectation, regardless of how you slice it, probably causes a little bit of downside volatility. If we're thinking about the pathing that we've outlined so far, maybe Monday's an update to close that gap in the S&P to the upside. We pull back on Tuesday. Lower high could be on the hot PCE, and this is speculation, obviously. I'm not trading based on the levels will be the levels. Price will tell us what we should do and the reaction at the levels. But I'm just thinking, would it be reasonable that PCE as a hot read on Wednesday could be the lower high back inside of the tariff turmoil zone? It's possible if the read's hot, and it's pretty solid expectation to have to beat here at a 0.1 on the month-over-month. So we're watching out for that. As we move into the remainder of the week, we will get some sustained job information, labor information, jobless claims here coming out on Thursday morning, as they typically do, looking for 224. We actually saw a downtick last week in the continued claims, which to me is an indication that the labor market's doing A-OK, not an issue whatsoever. ISM manufacturing PMI on the Thursday session. That means that ISM services is going to be the next week, early on in May. PMIs on the flash side from the S&P, they came in okay, but the notes on the actual reports from everyone surveyed, basically purchasing managers, they were really making note of higher costs because of the tariffs and having to basically pass that along to consumers. So we're watching out for that. It's one of the reasons why, again, PCE probably shouldn't have any impact yet from the tariff stuff, but it's definitely coming down the pipeline. As we look at Friday's session, it's the full Monty labor report, hourly earnings, the true NFP government read here. 129 is the expectation. Not jobless claims, but the unemployment rate month over month, looking for a 4.2, which is pretty stable out of the market. If I just flip back over here for a brief second, then we'll take a look at earnings. I do want to bring up the unemployment rate and just zoom in over here. Let's get that sickness spike off the screen. It's been really stable out of a 4.2. We got a 3.8, was it back here? Yeah, no, 3.94% flat. Regardless, really stable. And what this has allowed basically is the SOM recession rule to pull back, indicating less of a chance for a recession. This would have to be over the 50% mark if that is going to trigger once again. We'll see how that changes on Friday. Back on over to the dashboard for earnings. One of the concepts we've been talking about on the fundamental front is guidance walking forward with all of the tariffs. And if companies pull guidance, that would be a really bearish indication. Now, what you can see here from FactSet's report is that negative guidance for Q2 is actually below the 5 and 10-year average, which is kind of amazing to think about, right? Among all of this uncertainty, the amount of companies issuing negative guidance is right here at 45%. And you could say, like, we're not all the way there yet, and it's still very early, right? You could see it's only 22 companies. So this is subject to change, and we'll see how it progresses. But 45% as of right now, below 57% average on the 5-year and a 62% average of negative guidance on the 10-year. So watching out for that as of right now. It continues to be a slightly surprising metric here that is a little bit more optimistic, I would certainly say, keeping us open-minded to better than expected outcomes, that bullish continuation in the upward direction. Here's the earnings calendar for the coming weeks worth of trade. Domino's Pizza before the open on Monday. Gross, get it out of here. We get Waste Management, pretty solid as a recession-proof company. That would be something to watch out for. WM, see their comments after the close on Monday. But then it's really, if I had to start talking about some heavy hitters here, Visa for the XLF is going to be a big deal. UPS always has good insights, just like FedEx. Coca-Cola, just as a consumer staples company, right? And then, of course, your heavy hitters. Microsoft, Meta, Robinhood, get your popcorn out. Qualcomm could get your popcorn out for that one as well. We will take a look at Amazon, Apple on the Thursday session. Eli Lilly before the open on Thursday also as a key component of the XLV. MasterCard, probably a rinse and repeat of Visa earnings, but we'll just watch out if there's any discrepancies. Big deal there for our good friends in the XLF financials. Big Bear AI is going to get some probably notable press on earnings. We'll see how that ultimately plays out there. What else? I think that's really it. That's all I'm focused on for this upcoming week's worth of trade. Your heavy hitters, if I had to emphasize just, of course, a few, it's got to be your Mag 7 companies, Microsoft, Meta, Amazon, and Apple. All this week should get the market rocking and rolling. Let's take a look back on over to the platform and let's move into some of our additional indications. Bonds relative to themselves, still not out of the woods on the inflation from tariffs, right? And this is what we've been talking about. This is still in a downtrend here versus this going more sideways here. You can see that we're still over the breakout point. So the longer end of the curve moving in the upward direction relative to the shorter end of the curve would indicate that rates on the long side are moving higher in response to inflation. So that stagflation concern is still absolutely top of mind. We'll see how the GDP prints come out, not early, but midpoint of this week on Wednesday to confirm stagflation or not. Or if we should say, oh no, growth is doing fine, and it looks like we'll be A-okay. Let's jump on into, credit spreads, which are a massive improvement. Remember, one of the things we've been watching for is, can we make lower lows? And the answer is absolutely. Lower low happening here, lower low happening here. This helps support the bull case in the S&P 500. Let's take a look at junk in isolation. It continues to move in the upward direction, giving us the bullish divergence on the first go around here, getting some follow through out of the S&P higher on that Friday session, so that's helpful. As we look at Bitcoin, we already looked at it really in the risk on-off A-B charts, but over the 92,000, bullish indication here. Let's jump on into breadth. This is your thrust, big move from oversold basically, and this is not the same as the Zweig breadth thrust we mentioned in the intro and that study set there, but generally it echoes the same sentiment where you can see what was really oversold, is right back to now unchanged and even positive. Notice that we have a positive 13 on the week out of new highs versus lows, moving averages both moving in the upward direction here. It is a helpful indication for markets broadening out the rally and not just seeing a handful of names responsible for the uptick here. RSP moving in the upward direction really has a tough battleground though at 172. We'll be watching that very closely. If the S&P let's say that the S&P breaks out through this, right, as the RSP makes it into 172. If this pullback happens, you need to sustain the higher low above as this sets a higher low here and hopefully breaks out after a higher low is produced. If there's just a straight shot through 172, no concerns for the S&P. Moving along to the QQQE for the equal weight NASDAQ, you're already through the level. This is much more bullish here out of the NASDAQ side of things, concentrated in tech. If you take a look at, we could look at industrials versus transports real quick. Transports ideally get up and out of this range. It's something to continue watching. One of the things that is, we're in somewhat of a different world, right? Where it's not like goods moving around is the core. To some degree, the cyclical side of the economy is, but it's a much more service-based economy now. So is the Dow transport theory really all that useful? I mean, there's a reason why we've skipped it in like a majority of videos over the last little bit, but for the bears who maybe want a bearish data point to lean into, Dow Jones transports, not really playing nicely with the remainder of the thesis there. Let's check in on our good friend, the VIX volatility. So this is where I've got a little bit of a question to pose to you, and we'll answer it together. VIX volatility has moved from its capitulation style like spike here. It is drifting in the downward direction. That is bullish, but the VIX is based on 30-day options, and keep that in mind for just a moment. So this is helpful. I like that it's moving lower. It's definitely more of a bullish indication than a bearish one. But let's take a look at some other volatility indications. And we see the VIX of VIX, which is VVIX, is certainly moving lower. It's back underneath the 103. So again, this is helpful. I like the fact that as the market's moving higher, of course, this is happening. Also, if you just take a look at the Monday breakdown, right? On Monday's breakdown, when you made the equal low, you actually had a lower high here in the VIX, right? Relative to the previous, actually it was like way lower. This was the previous equal low that we were just describing out of the S&P. So this is helpful. This is all bullish. It's all very, very bullish. But in the intro, I said that there was one more signal that needs to happen. And that comes from this. This is your behind the curtain look at volatility. Now, don't get me wrong. It's strong steps in the right direction. But the one-day VIX is what I'm talking about. Let's take a cruise on over to our good friend, the SPX. And let's take a look at the options data here. Let's close up some of these and let's go to a 30-day. Oh, look at that. It's conveniently open because I was doing my homework. 30-day out options. What does it look like in terms of this is your volume column. The next one over is open interest. Let's take a look at the put side because ultimately this is kind of where, the VIX is being determined from. There's not even enough volume on the put side 30-day out in the S&P, this is the SPX. Okay, Matt, that's like a really expensive product. Nobody's transacting 30 days out on that. Okay, let's go to the SPY. Let's go to the SPY. Let's take a look at roughly 30 days out to the end of May. What do we have here? There's some volume. There's some transactions taking place. This is the call side. This is the put side. Let's take a look, right? But then come on up to something like, obviously, Monday is the next expiration that's closest. Does the volume even compare? It's not even close. All of the volatility metrics that we should care about is the amount of volume that's transacting in these short-dated expirations. I mean, if you were to look at, if we could still pull up the history for the zero DTEs, can we actually get maybe today's option statistics down towards the bottom? Let's go here. Yeah, there we go. So, I mean, I'm not going to be able to parse this out as to volume per strike, but 10 million options contracts went through on the S&P, and I would have to imagine that a decent majority of them were at really short-dated expiration. So the point I'm trying to illustrate is that although the VIX is certainly moving in the downward direction very substantially, and again, I'm not saying that this isn't a bullish indication. Please do not get my words twisted. This is bullish, moving from over 40 to sub 30. Bullish indication undoubtedly. Even, I think the more respected move is from over 50 to under 30. That is historically going to mark an internal low in the market, right? So bullish here, undoubtedly. But is it really when all of the volume that's transacting is in the short-dated expirations? Look at your one-day VIX. Yeah, I mean, as the market broke out on Friday, it made a lower wick underneath 2145, but I don't know about you. Yeah, it looks like a descending triangle, a falling wedge, not really a falling wedge, but a descending triangle, absolutely. It looks like it wants to move lower, but it has not yet. So that is, I think, the final shoe to drop here to truly say, like, okay, we're out of the woods. Let's relax a little bit and maybe look for this grind to start in the upward direction. As you take a look at the volatility futures, contango versus backwardation, we're still in backwardation. So once again, are we fully out of the woods? Is it like, oh my God, let's party and let's move on up to the all-time highs? Not really. I mean, you're still in backwardation here. And we can even take a look through the lens of the VIX futures. If I just show you this curve down here, let's get a little scroll. There we go. We're still in backwardation. If this is going to invert and do something that looks like this, great. You can actually see that there's a little bit of contango between the June and July contracts, a little bit less volatility between June and July. This is a small uptick here, but generally speaking, the curve is still lower. If this can invert and ultimately do something that looks like this, that's where we start feeling much more confident about that grind in the upward direction. So really, volatility continues to be the final shoe to drop in terms of confirming a majority of the indications flipping over to the bull thesis, being supportive of the bull thesis. If volatility can do it, that would really, be the final straw breaking the bear case and probably indicating that we're not going to revisit the lows, at least in short order. Let's jump on into the core list of companies. Let's finish up today's episode on a strong note and then 3 trade ideas for you. NVIDIA is up first on the chopping block. What do we see? Same concept as the broad market, where if this is a double bottom, it's a high or low double bottom. Most importantly, you've seen the recovery into the Thursday-Friday sessions over 104.75, meaning that any higher low pullbacks here probably keep another higher low on the table. If that's the case, I would look for longs into the equal highs. This is the 90-day pause at 114.25. If we can get consolidation here, call it for what it is. It's a bull flag in the short term, and this Brigade bolt to the upside should yield these previous highs back here. Here it is on the hourly time scale. You can see what goes straight up can easily come straight back down, but once again, a hold of 104.75 is ideal for a daily higher low. All the same indications as the broad market, where this did not yield a lower high that sustained itself. The gap did not close all the way. Stronger sellers not here. This is your key line in the sand, 104.75. Moving along to Microsoft, earnings this week, so please be aware of your options implied volatility. You're getting much more of a range in this box down here, maybe double bottom if you want to call it out like that. Over the top end at 392 could yield the major lower high threat above. Why is that major? Because as we zoom out, all of this overhead supply exists up here at 403.25. So we're watching out for that. The other thing, just like NVIDIA, is that this move is fairly straight up. Very, very strong day on Thursday. So if the consolidation is going to take place ahead of earnings, I would love to see a potential hourly higher low at 384.50. If that fails and we get a lower high underneath, a daily higher low at 377.25. Why 377.25? We've been talking about this for quite a bit. Previous lows from back here would then have the opportunity to act as support. If we fail 377.25, obviously looking for the gap to close down below, and anything goes after earnings. I will not have a position on through earnings. I never do. It is a gamble, right? You have implied volatility crush working against you. You have theta crush working against you. 50-50 shot, higher or lower. It's market expectations. You could do all the math. You could do everything in the world. Unless you get a move outside of the market maker expected move, your options will be crushed if you are trading directional singles on the long side, short side, meaning just long calls, long puts. If you have some sort of spread on, that's a different story. You do you. That's outside the scope of, we're not going to sit here talking about spreads and the strategy for that all day. The technical levels will prevail. Here's the Apple chart. Excuse me. Lingering today. Apple chart. Another one. My apologies, folks. If we could stay over 200, that starts to look really compelling for a higher low in the trend count. You have lows, you have higher lows, you have higher lows. Also over the 90-day pause high. This is the pause on the electronic tariffs, which was again, the very, very confusing in terms of what tariffs are being applied to what and who has this and who's in trade craziness. So if we could stay over 200, that would sustain a higher low. Gap fill reversal gets interesting, or the straight up grind into 213 is also interesting, noting that the hourly time scale, and just to give you a level here as well, helper perhaps at 209.50 would be what I throw on the chart here. Let's do that together. Beautiful. Over 209.50, you're looking at continued thin structure retracement and then a gap to close overhead at your daily 50 SMA. That's over 213, closes at 220.75. Apple in nature is more of a grinder, so don't expect this big, big green bullish bar unless there's an actual catalyst on Apple itself. That's that one. Let's move along to Amazon. And again, earnings on Microsoft, Apple, Amazon, and Meta, which we'll get to shortly. Let's get into the daily time frame chart first. This is just the balance range down here. If we can break out over the neckline of the double bottom and recapture this previous area of support, which can now act as resistance for that weekly lower high, 192.25, that would start to become more compelling. You have to get there first, and then you have to break through it. I would say that any consolidation here over 183.50 is looking pretty decent. Let's go on down to the hourly time chart to see that. You could see here, previous resistance, overshoot, but on the gap up, then resistance here, resistance there for your Brigade bolt underneath. If we can recapture that, the opening print of this session as well, if we could stay above that with confidence, that's where I would start thinking about that higher low thesis. Anything underneath is all about the gap close, of course, and anything goes Thursday after the bell with earnings. Keep in mind that the IV might not even be worth trading, Monday, Tuesday. The IV could be so pumped up that, the bang for your buck may not be worth it. So just be mindful of that stuff out of Amazon, but the technical levels still prevail. This is your major weekly lower high threat. This is your key hold on the daily time scale if we're going to stay outside of this as a range underneath us. Let's move along to Google, who reported earnings. And I think it's worth calling out that Google reported pretty positive news on the ad front with their earnings, which is kind of counter to the idea that a recession is either underway or about to be underway. If companies were really feeling it, right, an easy way to start reducing costs is to just stop marketing, right, or market less. So that's not really taking place. We also saw that the jobless claims last week were out of control. Another easy way to reduce costs, right, is to reduce headcount. So none of that's really happening here. So just sort of tying it into the fundamental conversation we had about the recession. If the Google chart pulls back, let's go to the daily time scale first. The double bottom neckline wants to act as your support, which is starting to step up as of Friday's low. Even the gap fill reversal I would qualify as being within the realm of possibilities there. So if we could hold up over 159.65, I like the double bottom reversal. I like the higher low over the neckline. Consolidation here, then starts talking about upside targets over 166.35, 170.25. Here it is on the hourly time chart. I just want to point out the thin structure on the way down, right? So if you could, this is another Stevie Wonder candidate actually early on in the Monday session. If you open under 163 over 161, a quick squeeze over 163 could easily get you back up here through the thin structure on Friday, fading all morning, and into this previous high at 166.35. That would be a trade that I watch out for early on in the session. For anybody who doesn't know what I mean by Stevie Wonder trade, you're going in off the open and you're sizing the position for zero. You're using options, and whatever you put into the trade, the premium paid is your risk. So if you want to risk $100, go find a $100 call option or two $50 call options and look for the market to squeeze out through that. If it doesn't work and it fizzles out, you probably shouldn't let it go all the way to zero. You might just want to start stopping out of it under previous day's low. And again, you have to do this only if you can actually manage the trade. You have to be comfortable with the amount of risk, but that's what I mean when I say Stevie Wonder. Dollars in the trade is your risked premium. If you break out, great, it works out. If it doesn't, then no harm, no foul. Let's take a look at Metaverse. Let's see what's going on with Meta. They have earnings, as we've just mentioned, so be prepared for that. IV crush as well. Generally, this chart looks much weaker than some of the other ones. I don't like the fact that it's so far off of its 90-day pause high, which is way back up here at 586. I do like the fact that it went gap fill reversal in sympathy to the Google news about ad revenue not being down. Meta's primary business, of course, falling into that rough category. So watching out for that. Next thing that I would really want to see happen here is a sustained higher low over 529.85 because of the way that this was the scene of the crime that led to the breakdown happening here. Really don't want to see it back down towards these lows, closing the gap. Some may argue like, oh, it would be good to come in and repair the structure and then move higher. I don't even want to see Meta here. It has to hold up over this level if it's even going to be a contender in the face of all these other names, which are far more bullish in the first place. So watching that, I wouldn't try to play the catch-up trade here out of Meta as the market's trying to come out of a low. I would stick with the leaders until the market's a raging bull market, and then you can look for your laggards to play catch-up, right? Let's move into Tesla. What an absolute, I'm not going to lie, I took like this much of the move out of Tesla versus the entire thing all day, rallying higher on Friday. Unbelievable move. Shout out to you guys if you caught it. We were talking about it as the top watch of the day in the pre-market prep over 260. What a clean chart setup. Just an absolute beauty of a setup here. After earnings, no issue on the IV front. Equal highs, breaking out. This was like the ideal target right up towards this high. It went beyond that for another, I think it was another 4% to get towards that high. But regardless, great looking move, great looking chart. I love the idea that this could break out as a balance range on momentum, up 8.89% on the Friday session. If we can get some follow through over this, look left. Look left at this, right? 303 might be a first place for a little bit of a pause, but this bar in particular, I'm really interested in the retracement through that into 326.50, the origin of that breakdown, just like Meta, we could call it the scene of the crime. If this is going to break out as a daily double bottom, I mean, let's just play devil's advocate. There's sort of your balance breakout rules that gets you closer to this pivot high 360. I would firstly be interested in this, absolutely, 326.50, but generally speaking, I think that Tesla has an opportunity here to put on a little bit of a showstopper and break out of this range. The 286.85 level, top of mind. If we take it on down to the hourly time scale, you can see how maybe this inverted head and shoulders kicks it all off. Gap fill reversal here on earnings. Equal highs. This was an inside bar on the Thursday session, inside Wednesday's range, right? Just everything that could have aligned and went well did at 260 through the daily 50 SMA. No hesitation here, really. A little bit of a hang up on the 5-minute chart, but straight through. You could easily see the argument for a pullback higher low here over this previous high. Even if you were to retrace to 260, I would take another shot at it long there on a higher low out of the range, looking back to the equal high on the daily range, which is here. Right, so really liking Tesla's chart. It'll continue to be a top watch into the coming weeks worth of trade. JP Morgan, looks okay. Inside bars up here out of the bull flag breakout, right, if you were to consider that. So all set on that front. This is helping the case for a bullish S&P 500, looking for a move out of the 3-day range for a range expansion, doubling of the range, to get you much closer to this last pivot high at 254. Watching that for your upside consolidation in here, not really interested. Let's move along to Netflix, see what's going on with Netflix over here. Just new all-time highs, a beautiful chart setup. I've got to admit, Netflix is one of these elusive names. If you trade the options on Netflix, you know this, but very, very spready. Tends to completely die out in volume after the first 15 minutes of the session. So if you trade Netflix, then kudos to you. There's a beautiful bull flag in here, right? So anybody who took that, fantastic, lovely on the Thursday session. Friday, really strong consolidation towards the highs. I think that this is going to give you just a very simple over or under. Underneath the 1092.75, look for the pullback, big retest happening here. Brigade Bolt on the higher time frame, something that looks like that. Consolidation and then bull flag breakout. I would just be mindful of your trade location. If you're a new money long just getting involved at the highest highs, just kind of understand where you're long from, right? I'm not saying it has to pull back and crash and you're going to, get totally wiped out there, but just be mindful of that risk, right? Be mindful of the amount of risk you're taking buying the highest high. So understand that out of Netflix. And with that, we'll jump into the 3 ideas. Some of these are earnings contenders, so please be aware of that. I think most of them are actually. Caterpillar, we're in the heat of earnings season, right? So what can you do? Caterpillar inside bar, bullish 3-bar play over the neckline of the higher low double bottom. Huge thin structure to retrace. I think the most compelling part about this is just that there's thin structure to retrace. So as long as we're over 301 out of Caterpillar, I would be looking for excuses to get long here, trying to move through this ahead of earnings. If you want to play it after earnings, we could wait and see as well. Maybe there's a subtle gap up. Maybe there's a move to here. As long as it doesn't take this out, I would generally think that the name of the game is higher lows, right? So that would be around here roughly. Let's just round down here, 283.50 as your round figure. Okay, so rough support there. That one's not precise. The 301, 313, 325.25, those are all accurate levels to the upside. You know what? There's no sense in being imprecise. Oh, I would bring it down just a hair here. I would bring it down to somewhere along the lines of 283. 283 is what I'm looking at. Not this low, but this low from the Monday fake out, if you will, of this week. That's Caterpillar. And again, look at the thin structure. This is why it's a primary idea. Over 301, right? Let's move into Zscaler. Let's get the click. There we go. Look at this chart on a higher time frame. This is take a look at this thing. Let's go to a weekly. Look at this weekly base that's built out here. Even with all the volatility recently, it was unable to make a new low underneath this like 155, 158 area. So all of these equal highs, I believe, are starting to act as a pressure cooker top. If the broad market's going to be in recovery mode, there's a gap to close over here on the daily time scale. Let's just quickly flip this to a daily chart, multiple years though. Here you go, right? Look at this. From the previous earnings cycle back here, all over the place on this volatility, that's what we're looking for. Thin structure retracement, gap to close overhead. Earnings are further out on this guy. Brigade Bolt's over 217. ZS, really, really strong watch here, I believe, based on the technical setup and the weekly base that is in play. If the broad market can get in gear, this is absolutely a name to be watching. That's ZS. Next up, Qualcomm, earnings candidate. Qualcomm, earnings candidate. Well, let's take a look. Daily time scale. I think that the idea here would be early in the week. If you get a rally rejection, I love the confluence out of the daily 50 SMA and just how precise all of these previous flat lows were. Qualcomm is not one of those high-flying semiconductors right now, so underneath this 150, I would be looking for a rejection there. So if you need a early week trade ahead of earnings and the broad market's pulling back hard, I would say that Qualcomm could be the contender up around this area. I would say that your pullback target is probably the equal highs of the tariff turmoil zone, which is going to be here as an equivalent, which let's just clean up the level, and then we will send you on your way for the session. Let's call that at 143.25 is going to be this, so on and so forth. So that's Qualcomm. A little bit of rally extension, rejection at 150.150, sayonara at the daily 50 SMA, looking for a pullback into 143.25 if the broad market is bearish, and pulling back. That's all I've got for you in today's episode of the weekly watch list, the weekend edition, if you will. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. We will be live, of course, at 8 o'clock Eastern time, as we always are, for the episode of the pre-market prep, giving you a game plan for the day ahead. We'll be up here in the office on Monday as soon as 8 o'clock rolls around. I hope to see you there. With that said, have yourself a green trading week, and I will see you in the next one.